Where are you going? Yeah, no, is that Chloe? Or Maddie? Okay. What's Finney doing? Okay, cool. All right, Mar, we are live now. Yeah, no, is that Chloe? All right, hold on a sec. Can you hear me, Mar?
I can hear you. Can you hear me?
Okay. What's Finney doing? Hold on a sec. I got to turn down my other audio here. Okay, cool. All right. So you can hear me, Amar?
I can hear you.
All right, cool. Good. You are live. All right, cool. We are live. Let me just hold on just a second. All right, cool. All right, sweet. Man, how come? There's got to be a way I can make it so we can both, we can see each other at the same time. Hold on. Let me go to gallery. Let's see what that
we should get that, the StreamYard. We should have done.
Yes. Yeah, no, I completely agree with you, man. 100% agree with you. I got to get that. Oh, yeah, okay. Looks like we're good. Looks like you can. All right, sweet. That's all I got to do. All right, sweet. I like that StreamYard because you can go on all the other platforms. A couple guys I follow use that StreamYard. That's pretty good. All right, cool. So it looks like we are live. All right. So as people start jumping in, all right. So you were saying something about your disclosure. You got to do your disclosure, Amar?
Yeah. So whenever you want me to do
just
that.
Go ahead right now, man. Yeah. Just go ahead if you want to do it.
All right. Let me pull it up.
You still got the boys, Coco? All right, cool. If anybody need to go outside, we have a new dog, Amar. I'm not sure if I told you.
I saw that on your thing.
Finnegan, that's his name. Finny for short. Finn for short. Sorry.
All right. So can you see my screen? Am I sharing my screen? Not yet.
Not yet. There we go. Yep, there you go. Cool. Oops. All right. Amar, he's so ugly. His mama dresses him funny. All right, you need to read that. Hey, drone.
Nope. I just have to put it on there so people have a fair chance of reading the whole disclosures.
How long does it got to sit on there for?
10 seconds, 20 seconds.
Okay, cool. So it doesn't have to be the whole time, just for right now.
Yeah. And then maybe we can do it at the very end as well.
Yeah, that's fine. Hey, we got Michaela. Says Josh and Amar. Amar says que paso.
Hey.
All right, so real quick, while we're letting people read that exciting content of your disclosure. All right, so folks, just real quick, let me reintroduce Amar. Amar and I used to work together for many, many moons at USAA. We've had him on this episode. We got Scott from Iowa many times. And Amar, good guy, one of the good guys in the business. We're working out a scenario because Amar is more of the high touch financial planning, which I can't do. And as we're moving forward. I get a lot of people say, hey, look, man, I can tell I'm not going to be suitable for them because I just don't have that high of a touch thing. And I worry that they're going to go into some maybe not the best planning scenarios that are out there. So I get a lot of questions like, who should I talk to and things like that. So would be more to this to come, but just keep in mind, if you're saying, man, I like that guy, Josh, but you don't mind paying a fee for service, but you need a little bit more high touch, then we're putting together some information for you to look at Amar because he's a good guy. He knows what's going on in the business. I know that for a fact. He's younger as well, and don't take that old guys as a negative. It just means there are some folks that are 58, 69 and stuff like that, and when they die, you're left with their son. And I've never liked that so much in this business. So keep in mind, hey Harry, keep in mind that we're going to be looking at that later on for sure, going into 2021. But today we want to talk about just taxes and investments, and Amar's got a nice little thing on his website for you to download it if you want. We can get this article that we're going to talk about. So just real quick, Amar, reintroduce yourself if you would. Tell them how cool you are. And
yeah. So My name's Amar. I'm a financial advisor here down in San Diego. And I have a small practice where I help people that are in retirement make financial planning decisions around investments, taxes, and estate planning. We also serve as a trustee for some of our clients. So if you have family dynamics or if you have assets that are spread out far apart and you don't have family members that want to take on that responsibility, then we can step in and help.
Yeah, absolutely. And the benefit of that actually is, I mean, I get questions all the time. Do I need a trust? And, you know, I'm not an attorney, but by and large, the answer is no. But there are some kids who's going to inherit quite a bit of money who could easily sniff that up their nose. And what a trust can do is to prevent that from happening. But it has to prevent it from happening with competent trustees. What is someone who would step in if you're incapacitated or at your death? And if you just leave a child, say $2 million, and the child has a propensity to to partying like it was 1999, that could be problematic for sure. And so that's where a trustee can come in. I don't get this question a lot, but I get enough, easily 5 or probably a dozen times a year. And you got a bank trustee, and we're just, while I'm yapping here, got the bank, and I just tell you, I've never been all that impressed with bank trustees. I'm not sure.
Yeah, and the bank trustee wants to sell bank products too, right? So typically, if you have real estate or anything like that, they'll sell that real estate to fund their bank investment product. And the bank trustee is very limited by the corporate structure too, right? Whereas we have that flexibility to do things that larger institutions wouldn't normally do.
Well, I've noticed when I was working at First Union Bank, this is before your time, Amar, when you were still in Dipes. First Union Bank, I'll never forget, we had this in Harrisonburg, where the guy was stationed at Roanoke, and once every 2 to 3 weeks he'd come up, and it was always like at the privilege of his clients he would be there, and it's just cocky as could be. It's like, dude, I could tell he just it wasn't good. Anyway, all right. So let's talk about taxes and investments. And I have that right there. So let's go over what you want to talk about, Amar. And we'll just go.
So I'm going to share my screen. Yep. So long story short, I've been working with a few clients, and when I'm reviewing their investment statements from other investment managers, I realize 5 things that they're not. I don't know if it's front of mind or their investment advisor is not really focused on that, but that can have a big impact. Remember, taxes and fees are probably the 2 biggest headwinds in retirement. So this is kind of catered towards that. But let's just hop into it. So the first thing that I see.
Make it bigger by chance, Amar? Can you make the font bigger or the type bigger?
It's not getting bigger. It says 200% on my side.
That's fine. That's all right. They can still download this on your website, right?
So you have this link right here that you'll put on the video, right?
Yeah.
I emailed it to you as well, Josh. And go to clientfirstcap.com, insights, articles, and updates. You can come here to the top 5 tips as well. And then at the very bottom, there's a link here to download the complete guide, which really goes over how we plan for these things as well.
You said you did email that to me? Okay.
Yeah.
All right. Well, go ahead. I was going to put it on there now, but I don't see your email. All right.
Can I put it on there? Can I just copy it and put it in the chat? Or
yeah, absolutely. Yes, sir.
How does that work? Or so just bear with us.
Yeah, just copy and put it right in their chat. And I'll put it in the show note. You can't put it in the comments until the live stream is done. It's kind of weird, but.
Yeah. So can you see it there? I just sent it to you via chat.
Not yet, but we'll get it. Just keep you go.
All right. Anyway, so the first thing that I see that people in retirement that don't really take advantage of is long-term capital gains, right? So like the key point here is that most people, their ordinary income tax rate may be higher than long-term capital gains. And so I've seen multiple times where, you're maybe like 30 to 60 days away from being 1 full year and getting favorable tax treatment. And so the important thing here that I would say is to understand the timing of when you have investments and how long will it take to get to that 1 year mark to switch over to long-term capital gains. Josh, I'm sure you've seen this too, where investment managers, they put investments to fit a box,
Yeah.
right? Like they got these like models that they have to fit into, and sometimes that triggers a larger short-term capital gain.
Yep.
So,
And they'll have the same allocation across taxable, tax deferred, and tax free accounts too.
yeah, well, we're going to get into that one here in a bit.
Good.
The other thing that I
Real
see,
quick, Amar, if you see me looking, I'm just looking at my other software, my other computer. So I'm paying attention to you. I just, I'm trying to get this article so I can put it in the comments. So just keep going.
the other thing that I see, the investment turnover, right? Like, if you have a mutual fund or a separately managed account, there's probably a lot of transactions in there, even though you don't see them on your statements, but within the fund, there's a lot of transactions, and that turnover could be quite costly. I think in 2019, the average turnover for a mutual fund was 63%, which is quite high. All those transactions, if they're in a taxable account, they trickle down to the end investor through a 1099 form that you get. So you could have situations where a mutual fund would have lost money, but they distribute a gain by the transactions that they do within the fund. And so managing turnover is important, especially in retirement where you're trying to dial in each piece of your income. What we would say is, look at the prospectus of the mutual fund, look at the average turnover, and just do some math. You multiply that turnover by the asset size, then you know how much they're transacting and how much you could have as potential gain or distribution in form of a dividend on your actual tax return. Josh, you have anything that you want to add to investment turnover?
No, not yet. Just no, keep going, man. Absolutely. We'll get all this here in a second. Just keep reading your stuff here.
All right. So the third thing that I would say is utilizing lot specific accounting.
Exactly, yeah.
So when Josh, and you'll remember this, when we were at USAA, we did average cost basis.
Yeah.
All the big firms, it's easier to do the accounting by using average cost basis. And they have all the data for lot specific, but it's easier to produce 1099s where it's just the average cost basis, right? Less line items, if you will. But this could be a disadvantage to you as the end consumer, because when we're doing average cost basis, you will have specific lots in there that would have a higher or lower cost basis. So let me step back and kind of explain what cost basis is. So when you purchase a security, you purchase it for a certain dollar amount. That is your basis in that investment. 2 or 3 months later, you like that security, but the investment has gone down.
Yep.
You can buy some more. When you do average cost basis, they take both of those purchases and they give you an average cost per share. When you're doing lot specific, you're getting a lot for this initial purchase and you're getting a separate lot for this purchase that you did later on. And the reason why this is so important is that you could sell specific lots of an investment to reduce your capital gains. So when we think of, in our firm, we do highest cost last out. So you want your highest cost securities, long-term capital gains, to be the first ones that we take out of your investment. It reduces your overall gain, right? That's what we're trying to do. When you're doing charitable giving, you want to give the lots that have the lowest cost basis, right? So let's say you own 100 shares of Apple or some security, and you bought 50 up front and 50 later on. You want to gift the one that has the lower cost basis between the two. So the key point here is that the extra work of tracking your lot basis, which is not much extra work on your behalf, it's all on the custodian. You could save thousands of dollars in just managing that lot specific accounting. The fourth thing is to be strategic with which investment account you use to purchase your securities, right? So a lot of times if you go to one of the bigger institutions, you'll have a moderate risk tolerance, but your IRA will be moderate, your Roth IRA will be moderate, and so will your taxable account. That's not how you want to invest money. And what we know is that you want to take advantage of long-term capital gains in your taxable account. You want the most amount of growth in your Roth IRA because that's tax-free. And we want in your IRA to be where all the transactions happen because it doesn't issue, it's a non-taxable event. The only taxable event in the IRA is when you take income out, and that counts as ordinary income. And so when you're owning bonds that pay interest and dividends, it makes it an ideal place to hold that stuff in your IRA. So again, high transactions. So if you're rebalancing, you want to have that in your IRA. Or if you have bonds, you want to own it in your IRA. Now, these are bonds that are taxable. We're not talking about municipal bonds or any of those tax-free bonds. But, you know, everybody has different dollar amounts in each one of those buckets. So you do the best that you can, but you shouldn't have the exact same model in your taxable account and your IRA and your Roth IRA. That doesn't make sense. No. And then this one, I don't know, everybody has a different opinion, but this is our opinion. You should know when to use your tax loss harvesting. A lot of CPAs will tell their clients, hey, call your advisor and do as much tax loss harvesting as you can do this year, right? And every year they'll do that to create those losses so then they could reduce the income. But in reality, what you're doing is if you bought a security here, you're taking a loss, and then you're repurchasing the security, you know, after 30 days, or a like security that's, you know, 70% different. But then when that security eventually rebounds, you're going to have a larger gain on that security, right? And so what we tell clients is that we want to wait to use tax loss harvesting in the years where you have large gains. We don't want to use it just because every single year you have to, you know, take some losses. So that way, you know, you can write off on your tax return those investment losses. Because what you do is then you just move the tax burden to a future year, and it's a larger tax burden based off of that. So these are the 5 key things that I've seen recently within the investments that I've tried to, you know, kind of coach potential clients, future clients, that like, this is what we can do better, right? Take advantage of long-term capital gains. Use index funds to manage turnover. Utilize lot-specific accounting to make sure that if we're doing a charitable gift, we're gifting the highest amount of gain instead of the average cost basis method. And making sure that we have our high growth investments in the Roth IRA, our buy and hold in our taxable account, and rebalancing with the IRA so the overall risk tolerance is moderate, not each specific account. And then lastly, be strategic when we use tax loss harvesting.
Yeah, absolutely, Amar. And on that, they can download this right here. If
you just click this red button here, and it'll take you to the PDF where you can just download it. It's asked for, you know, just some information, so that way we can.
Well, scroll down for just a second. So I want to be scroll down on this page right here, Amar.
Yeah.
Here it says, I'm interested. I'd like to receive regular emails. So you have to affirmatively check those if you want to receive regular emails from Amar.
Yeah, if you don't check any of these things, right, then we're just going to send the PDF document.
Yeah, exactly. So he's not going to. I get this on myself. It's like I send out emails. I got a guy who opened up a number of my emails, and yesterday said, I never signed up for this. Like, yes, you did. And you open up a bunch of them. And so I don't, if you don't want it, you can get,
yeah, just don't check it if you don't want it.
Exactly. And I said, well, I don't just go in there and say, hey, here's Amar. I'm going to put his name in my email list. It's weird to me. In fact, when you're signing up for emails, just FYI, folks, is that it actually costs the provider, like me, I have to pay for the emails that I have. So I don't want you on my list if you're not if you don't want to be receiving me. So can you
And you can see about every 2 weeks or so, we put out an article, right? So, we were talking about Medicare here because of open enrollment. We do stuff about multi-generational planning, market outlooks, changing landscape of education, going through COVID and all. And so, we've been doing this for a while. We've got a lot of good content on here. And again, if you want it, then click the box. If you don't want it and you just want the PDF, you can still get that too.
Let's bring up Amar on show. Let's see on let's pick out what's a big fund. Let's pick out the Fidelity Contra Fund. Let's see. And I want to go to the prospectus, and you know how they have the before on the prospectus. Maybe you could do this. We'll just pick out the Fidelity Contra Fund. That's just one that comes to mind. On the prospectus, it says returns before taxes, after taxes as well. You know what I'm talking about?
Yeah, here, I'm going to share my screen, and then you can walk me through it too.
Absolutely. Because, yeah, there we go.
So I just went to fidelity.com and I put the Contra Fund ticker symbol.
Yep, good.
And then over here, you get the prospectus.
Yep, exactly. And what we're going to do is go to, is it under SOCIALIZE? Just go to the prospectus. Okay, good. Scroll down right here, Mars.
It should be right here where they have.
Keep going down. Yep. That turnover right there.
Turnover.
Keep going. All right, so just real quick, let's
26%.
Yeah. So Amar, if I may, let me just Amar is a CFA and a CFP. The last I checked, only 1 or 2% of CFPs have a CFA as well. Yeah. And Amar's never gonna hey, I'm a CFA. He's not gonna be like that, Amar, he's not that cocky. He's cocky, but ain't that cocky. But we're not talking about some guy that just fell off the turnip truck, my friends. Both of us, and in fact, the vast majority of USAA folks that came from that firm were highly qualified, highly credentialed, but they're mostly just regular Joes. You know what I'm saying? They're not like, I'm working on freaking Wall Street, not like that. So let it be said that we're not talking with just some dude who got a Series 7. And there's nothing wrong with a dude who got a Series 7, but Amar and I we know what the hell we're doing, if that makes sense. And I just, I can't tell you, Amar, how many comments get like, I'm like, all right, whatever, then move on. I don't care. But not on my channel so much, but just by, fly by night guys that come in and say, you don't know anything, like whatever. All right. So anyway, let's read what it says about turnover. It said, you say, 26%. So Amar, tell people what that means exactly, if you don't mind.
So the mutual fund, your investments within the mutual fund have turned over 26% of the overall value of the account. So like this fund probably has somewhere in your, like what the net amount
probably got 500 shares or something, stocks I bet, or something like that. No, the top 10 is 48% of the holdings. Look at that, Amar. So yeah, that's woo. That's pretty concentrated. So, yikes.
Oh, here it is. The net. So this has turned over 26% of this amount.
Yes.
They've done transactions on. So you could take whatever amount that you have invested and multiply it out, and you'll get what you can expect as taxable consequences between that turnover. Now, not all of it will be gains. There could be some losses in there, but you'll get like the high water mark, and worst case scenario, it will be that number, but most of the time it'll be below that.
And there ain't no gains, ain't no losses over the last 12 years. You know what I'm saying? So that turnover that they're paying is going to come to you as significant gains, because we have had no losses since 2009. Yeah, I mean, that's just a fact. All right, get off that screen real quick, Amar, and we'll come back to this here in just a second. I'm not picking on Contra Fund. I like Danoff, who's a manager, but I just want to point out that it's a pretty popular fund. And I say, look, there's more to this than meets the eye. And if you're not careful, especially in a taxable account, you're going to get a 1099. And that 1099 is part of your provisional income, which means you may have to pay tax on it and your Social Security and your Medicare as well. All right, so what I want to do right now is my green screen. I got my Common Sense on Mutual Funds by John Bogle, and we're just going to read from page 92. And again, Amar, John Bogle signed it. You don't have this book. I do. I got Bogle to sign it when I was a Vanguard stooge. So let's just read this real quick. The cost that actively managed funds incur in buying and selling portfolio securities are hidden, but nonetheless are real. Fund portfolio turnover averages something like 80% annually. It is expensive, perhaps as adding as much as 0.5 to 1%. That'd be 50 to 100 basis points in cost annually. So favor, in addition to the more favorable cost. So favor low turnover funds, and actually the Fidelity Contra fund with only 26% turnover will be considered more a lower turnover, believe it or not. But
absolutely, because the average for 2019 was 69% for U.S. large cap funds.
Yes. Yep. And then Bogle, this is written in 1998, by the way. Many high turnover funds also are expensive as well as tax inefficient. So it behooves you to consider after-tax returns along with the present unrealized gains, which could lead to potentially massive future capital gain distributions and the burden of unnecessary taxes. Now, going back to this, is going to be hard to avoid if you have any kind of stock fund. It's going to be tough to avoid having unnecessary capital gain distributions because, like I said, there has been no losses of any significance other than a couple times over the last 12 years or so. But that's why if you're not paying attention to this, you're just wrong. I'm just telling you, that's all there is to it. And so many people are wrong. And the way you pay attention to it is you look at your 1040 or you look at your 1099s. And if you have a 1040, it'll say, I don't have a blank one right here, but it'll say explicitly what you got to record to the IRS. It's nuts. And if you're not doing that and you're hiring somebody to do it for it, and he's not, what the hell are you paying for? It drives me up the wall. Can you go back to that contra fund perspectives real quick, Amar? I want to see if we can see the on the statement of it might be under the summary prospectus. And no one reads this stuff. I get it, but bring that summary prospectus back up if you'd be so kind. And I want to see where it says. Keep scrolling down. Keep going down. Oh, here we go. Yes, sweet. This might be your. Keep going down. Average annual. Right here. Yes. Right there. See where it says, Amar, it's going to be hard for me to read that. So return before taxes, return before tax on distributions, and return before tax on distributions and sale of fees. So if you can read that, let's look for the past.
So you start off with about 30% return, 29.98 for the last 1 year, right? And this ends December 31st, 2019. So this is about a year old, right? Then return after taxes on distribution is 28.6%. So there's that 1.5% that you were talking about earlier.
Exactly, right there. Right?
And then return after taxes on distributions and sales of fund shares is 18.59%. So that is, that's a large difference. That's like 10%.
That's a third of the portfolio. So if you even look at 10 years, it's not quite as drastic because it's long-term capital gain, but still look at that. 9.6 to 11.4. That's 250 basis points less after taxes and sale of funds. And even without even folding the funds, you're still losing 121.25%.
Yeah. And then just look at the S&P 500 index fund right here, right? So we're comparing right next to it. I mean, over 10 years, this is 13.56. And, they didn't take any deductions for fees, but, on average, the S&P 500 index fund has got to be less than 6 basis points. Yeah. Would you agree? So let's just call this 13.5. Yeah. And then over here, you're doing better than an actively managed mutual fund.
By far. By one.
And they don't include their fees on this, do they?
Yeah, it's actually, I don't know. It has to be because it's got to be NAV. It's got to be fees.
Yeah, okay.
It's got to be. So, but it wouldn't be if it's in a separately managed account, though, Amar. You see what I'm saying? So if
Yeah.
you have the contra fund and I don't know, you're friggin' Rick Edelman guy, and he's charging you 1.85. You're getting, I mean, it doesn't make sense unless you're getting unless that guy is coming and friggin' giving you a towel when you head out of the shower. Why are you paying that kind of crazy fees for? It doesn't make sense to me. And people say all the time, Amar, like, oh, but I'm getting all this service. Like, what service are you getting? I just, it's nuts to me. And again, if you are going to pay a fee, i.e., I'm going to hire Amar to be my trustee, that's different than paying a fee to hire Amar just to put myself in a bunch of separately managed accounts, which is what the Edelmans and Edelman came to mind. I'm not explicitly picking on them, but all these firms, they just put you in these push button investment warfare. We're going to have a mix of Vanguard and Fidelity and this and boink, and you're there. It actually drives me insane. Look at that, though. The numbers speak for themselves in any prospectus. This is a summary perspective. You can see it right there. And in fact, Amar, there's a blog post I did many moons ago, and I'm not going to be able to find it. Someone did a study that said there's even more fees that you don't even see before just turnover. I got to find that because it was one of the first blog posts ever done. And it was, you're sitting there thinking, it's nuts how much more fees are on top of fees on top of fees.
Yeah.
Going back to a video I just did today, talk about Wall Street is the business. The retail person is not the business. The retail person is financing that business. They don't care about us. That's for sure.
And even for us, I mean, as an investment firm, we do actively manage our clients' accounts, but on our fees, I mean, we do 6 meetings a year for our clients. So we start off with, what happened last year, like a year-end review. Then we go into a financial planning type meeting where we're saying, well, what are our goals for next year in alignment with there? Then we address, any risks that you'll have to your plan, to your investments. How much downside risk can you actually afford? That changes, for people. And as well as, are there risks outside our control? So long-term care, life insurance, like those are all different types of risk products that are out there, but we're looking at the underlying risk of those things. Then we go into a mid-year investment review, which is, around July. And then we turn into trust and estate planning type meeting to say, like, how much do we want to have at the end of life? Are we on track for that? Or are we above that or below that? And we can really identify how much spending needs to be done to be on track with that. And then we turn our attention to taxes in terms of what can we do between now and the end of the year to really fine tune the taxes. Now, this is our process and this is what we've built. So it's not for everybody, but if you are in retirement and this is something that you want as high touch, then you should give us a.
Not just retirement though. I think anyone who's like,
Anyway, but I mean, like our focus has been on.
Absolutely. Yeah. But if you're, some freaking guy over at Silicon Valley, for instance, and you're like, you got 8,000 things going on. You know what I'm saying? You're like, dude, I don't want to, I just.
Yeah. I mean, we're there for you in terms of a high touch solution.
Absolutely. And so my man, let's go through some comments here real quick. You can always, Vinyl, you can always carry losses forward if you want to take gains now. You can always carry losses forward if you don't want to take gains now. That's absolutely true. In fact, that would go along the lines with ride your winners and cut your losses. But with that said, remember, some of these robo-advisors in particular, they hold themselves out as they're doing all these tax loss harvesting things as if it's a panacea. It's just, I mean, there's nothing inherently that's going to make your portfolio better or worse by tax loss harvesting, because you're still going to pay the piper at some point. So Chuck asked about the wash rules. He says those concern him with tax loss harvesting. Amar, speak to this. Chuck says, I hear that IRA activity can affect the taxable account wash rules. Actually, good. I don't know that to be true or not. I don't know. Know anything?
Yeah, I mean, so the IRS looks at your account as a whole, right? So regardless of where you hold the security, so that is correct. Like if you bought a security in your IRA and you sold it in your taxable account, you own the same security in your taxable account and you sold it, and then you bought it back in your IRA or bought more in your IRA, that could create a wash sale rule. Yes, that is correct.
That's good. That's good piece of tidbit there. Marie asked, index funds or annuities, and they're not mutually exclusive, but Mar, tackle that for a little bit while I'm just typing on some of the comments here.
Yeah, so index funds, I mean, you can own index funds in an annuity too. I mean, so the question is kind of, there's a million ways that we can go, but
maybe
high level.
Maria, elaborate while Mara's talking, maybe elaborate a little bit, Marie, too, but Mar, keep going. Absolutely. Keep going.
High level, an annuity is a product where you want to transfer risk, longevity risk, to a pool, right? That's like their main, that is the main reason why you buy an annuity. The second reason is that in the annuity, you get tax deferral. So you're not getting a 1099 each year, but then at the end, all the gains come out first as ordinary income. And so that's not as tax advantageous as it could be, right? And when you're looking at a taxable account, index fund, it's going to have turnover as well, but it's going to be like this contra fund, probably less than 25% on average. And I would be interested to see. Let me see if I can just look up, see if I can pull up the
turnover.
Yeah. So I'm just putting in SPY, right? Because that's like the most most used.
Yeah, there you go. Vinyl, right on. So we got a good, my man Vinyl from Connecticut. So you know he's rich. He lives in Connecticut, Amar. You're San Diego, so we know you're lighting cigars and $100 bills. But he said the same thing about the wash rule. So good job, Vinyl.
Yeah.
It's very difficult for retirees with high incomes to avoid tax. You think?
Well, so let me talk real quick about 3 things that we've been focused on to help reduce taxes, right? So like number 1, if you're charitably inclined, doing a QCD, qualified charitable distribution, is probably a really good thing, because that takes your this year there was no RMD, but next year if you do it, it counts for your RMD. The other thing is that you could do Roth conversions. So you want to maximize the tax bracket that you're in to reduce future years' taxes. Or if one spouse were to pass away, then they're on the single taxpayer tax brackets and they lose a standard deduction, you still have the same IRA assets. So you can protect some of that. And then also for your children, if you have a Roth IRA, they can leave it in there for 10 years. Right, and then take distribution, so that could grow tax deferred, tax free for 10 years beyond your life expectancy, and then they can use that asset. So really leveraging the Roth there. The other thing is donor advised funds. So let's say if you have an ability that you have securities that have significant gains, and we use the lot specific accounting, and we can identify those assets. Those are the assets that you should put in a donor advised fund. And these are both if you're charitably inclined, right? So those are 2 ways for high income earners to reduce their modified adjusted gross income for Medicare calculations, and just their overall taxes just in the future.
So go back to annuities versus index funds. So Maria, if you're still out there, just elaborate a little bit what your thinking is, because that'd be like saying that's just a very encompassing, broad, encompassing topic. So maybe so my man Ben Sloan says, what about CRTs, Amar? You want to talk about those by chance?
Yeah, charitable remainder trusts. I mean, we act as custodians on a few charitable remainder trusts. We serve as a trustee with Fidelity or Schwab. And the CRT is a good way to take that highly appreciated security and bring income back into your portfolio. So you can eliminate that large gain on that security. You can have income come back to live off of. And then at the end of life, those assets would go directly to the charity. So we use Kugler, which I don't, Josh, do you remember that software?
Yeah.
Kugler estate planning software to do the interest rate calculation. I guess the question, is there a specific question with CRTs, or is that just like, essentially it's a trust that you're creating to transfer gains of a security into the trust and then create income coming back.
And you got
income coming back
as a recipient of the income, right? You're still paying ordinary income on that. Okay.
You're paying long-term capital gains. So it comes out ordinary income first, dividends, taxable interest, and then long-term capital gains. But the idea is to diversify that asset, number one. Number two, you're charitably inclined. So you have to have charitable intent for it to make sense. And number three is that you're getting some of that income back, and you can use that income now, right? So
if you're getting some of that income back, is it just return of principal, like tax-free, or?
No. So it's worst out first, right? So
Okay.
ordinary income.
Okay. Gotcha.
Dividends, interest,
Okay.
and then short-term capital gains, long-term capital gains, return of principal is part of that as well.
They still do rolling grats. It's been a while, but are you doing it?
Yeah, absolutely. And remember, with grats, you can substitute the asset that's in that that sale, right? So think about 2020 from a estate planning standpoint. We were in March and everything was down, right? So if you did a grat earlier, probably you lost money on it because what your sale value is and what the actual value is lower. So you could substitute that asset at that point and then create another grat if you wanted. Or if you did a grat and you did it in March, I mean, look how much gain that you've taken off of your balance sheet, right? And this balance sheet.
Go into a grat, because it's been, I guarantee no one knows it. It's been a long time since I looked at grat. So can you just give us the main need for understanding, which means the elementary understanding of a grat for us from Maine and stuff, if you don't mind?
Yeah. So the main benefit of a grat.
Well, I mean Maine, like being from the state of Maine, not the Maine, but gotcha.
The main, how I try to explain it is that instead of gifting assets, we're selling assets to your beneficiaries. And so you're able to take something that you think will continue to grow in value and get that off your balance sheet, right? And put that to your children. And all that gain goes into their estate. And there's some purchase, so some of the money's coming back, but you have more control over that. The other thing that we're seeing a lot of in terms of estate planning is SLATs, the spousal lifetime annuity trust. So if you're above the exemption amounts, right, and you want to, or if you want to lock in the exemption amounts because you feel Joe Biden, Georgia runoff, whatever, the state exemption amounts would reduce. All this printing we're doing, we need to raise taxes somewhere. If you're worried about the exemption amounts, spousal lifetime annuity trust is something that you can look at, where you can maximize the current exemption amounts and still retain the assets under your control, right? A lot of these grats, charitable and remainder trusts, are irrevocable trusts. So you actually are losing the asset, right? It's no longer, you don't control that asset anymore. Whereas in a spousal lifetime annuity trust, the SLAT, you're gifting the assets to each spouse using the exemption amounts. And so you're still getting income and you still get to use the asset. Now, if you have more than that, then those would be the last assets you touch. But that's basically how. I don't get what
the point of the SLAT. What's it called? Is it spousal lifetime annuity trust? Is that what you said?
Right. So what you're trying to do is use the exemption amounts, right? So like right now they're like 11 something, right? So you're trying to put as much money into that SLAT so that you don't have to pay estate tax.
But I don't get why you're just giving it to your spouse who gets the unlimited exemption anyway. So when she dies, isn't it still part of her estate?
No, it doesn't go into her estate.
Oh, it doesn't?
That's the whole point. Yeah.
Like a Q-tip then or something. Oh, wait, how's it? I can't remember. It's been so long.
The Q-tip, it's different because it's an irrevocable gift into the trust, for benefit of.
Q-tip is, but the SLAT is not.
It's not. Yeah.
Now, a grad, so Obama was trying to get rid of, do they still have 2-year grats? Or I know he was trying to get rid of something. I can't remember. The 2, 5, and 10. They still have all those, or?
Yeah. I mean, truth be told, we haven't worked on a rolling grat that's 2 years in a while.
Okay.
Yeah.
It's just been a long time. So with a grat, if I remember, you basically saying you get like a, yeah, it's just, I don't want to get too deep in that. It's
Yeah, let's focus on taxes now. We can do an estate planning YouTube thing where we talk about
all
complex
right. So
planning.
here's my man Chuck. He says Prime Cap has a 55.7 unrealized capital gain. Woo! So that's, now Chuck's got it in his IRA, thankfully. But I mean, and this isn't just Prime Cap. It's going to be, we didn't actually see what the one for Contra Fund was, but I guarantee there's going to be some serious unrealized long-term capital gains in every portfolio, and it's probably almost too late. I'm sure we're beyond, well beyond X date now, right?
Yeah, and most of these funds are distributing right now, this Thursday and Friday.
I gave I'll never forget this lady when I was at USA. And folks, she had $200,000 in American Century mutual funds that she did not buy from me, did not buy them from USA. She just had them. And she came to my office, freaking pissed as a bee in a bonnet. Pissed as Steely Joe getting a hard question like, what's 2 + 2? She was madder than a freaking Dr. Jill Biden not being called doctor because she's a doctor. She was madder than Amar's like, with this guy, just shut up with his politics. But anyway, so she was getting a 40% capital gain distribution on her American Century funds, even though she was down in value. She was down in value. So she had bought the funds at, we'll just say 2011. In 2011, the market was getting knocked around a little bit in inter-year. And now she's getting 40% capital gain distribution. And the years, I don't remember specifically, but it was around that time. Maybe it was 2013. So she was going to get this huge amounts of capital gain distributions, even though her account balance itself was less than what she started with, because she bought other people's capital gains. That's the problem with mutual funds in taxable accounts, is you are buying other investors' gains. And the other investors and the same thing happens with bond funds too, I might add. A lot of people think bond funds are exempt from this. No, sirree, Bobby. They're not. So you got to be paying attention to this. And if you aren't, and you're hiring some clown, and I guarantee he's not. You know why? Because how do clowns get paid? They get paid by bringing more and more assets in. That's what they get paid by. I'm just telling you right now, there are some people, most RIAs, smaller registered investment advisor firms who have a limit on how many clients they take, are going to probably serve you very well. The big boys, hell no. They're putting you in freaking push button warfare, investment management. They're saying, Marie, you're going here. Ben, you're going there. And that's it's nuts. Actually, it infuriates me because we know for a fact that taxes are one of the biggest detriments to overall investment success. It's nuts. And if you're not paying attention to the tax rules, you're leaving money on the table, and and you're being taken advantage of by Wall Street. All right. So Marie Amar followed up. She goes, I was thinking about risk and funds with no sharp increases or decrease. So Marie's looking at more about risk with annuities versus index funds. So you want to speak to that real quick?
I mean, you can have so I would tell Marie there's 87 different S&P 500 index funds in the investment universe. And so you can have an S&P 500 index fund in a brokerage account or in an annuity. The underlying risk is still the same, right? Because it's investing in the same things. I think the thing that I would say is, that if you need that guaranteed source of income or that recurring source of income, or you have to do financial planning. You have to say, this is my base costs or my base expenses. How much of that do I want to cover? And Social Security can cover X amount, and then if I need a little bit more to feel comfortable, then I would look at an annuity. But if you're not in that position, then I don't think annuities are the best way. Because remember, in addition to the fund expense, you're paying a mortality and expense fee. You're paying an administration fee. you're paying a contract fee. And I think there's a certain percentage of the M&E fee that goes to the state commissioner, insurance commissioner, right? Like I know with life insurance, it's a sales charge. There's something like that on annuities. I'm missing the terminology, but
the state
and you don't have control of the funds, right? Like in an annuity, you're going to have a set list of funds that you can choose from, right? Let's say it's 50 funds or whatever it is, but you don't have the universe of like Vanguard, iShares, like all the different index funds, spiders that you have available outside, right? So like one of the things, like let's say you wanted to have utilities in your portfolio, because a lot of people are looking for dividend income, right? And they may not be getting that with bonds. So they look at the next risk step would be either preferred stock or like utilities. They buy into a utility index fund. You may not have the option within your annuity, right? So that would be something to just be cognizant of.
And just along those lines, Mark will get you in second. Marie says, my 401k advisor wants me to go to annuity in retirement. Then Marie adds, which will benefit him more than index funds. So Marie, let's talk about this for just a second. There's nothing inherently evil about an annuity. And Amar wouldn't be saying that. I'm not saying that. Annuity is just an inanimate object. It's neither good nor bad. It does serve a purpose in a very minimal box of people that it serves, though. If you're worried about risk, like IULs, index universal life insurance, indexed annuities, all that, I don't like any of those. And the reason I've done many videos on that is because they don't include the dividends and they have participation caps and all these. I'm not a fan of them at all. So I'm not sure.
It's too complex, right? Like they have enough levers to pull to make it not worth. I mean, they're an insurance company. They have to be profitable, right?
100%. And if they're not profitable, then the State Guarantee Association, what Amar was talking about, is going to have to step in, and someone's paying for that. And it ain't the insurance company too. So if you're worried about risk, then the simple way to do that is to remember, index funds, you can have bonds that are index funds too. Just be advised. So we got to get out of this method of saying index funds means something, because it doesn't necessarily mean anything. It just is a bucket of stocks that are not actively managed for the most part, and they're typically lower fees. So if you're worried about a sharp decline, annuity isn't the option in of itself. It's just, you can say, I'm just going to ride it out. I'm going to go to a bond index, or I'm going to go to a CD, or I'm going to go to a stable value fund in my 401k to ride out what you think is a pending threat. And that might be valid. It might not be valid. But kind of what Amar said to start this, financial planning is key, because just talking investments without having a strategy behind it doesn't make any sense.
Yeah, we don't know how much income you need, how much expenses you want to cover. And I see this a lot with teachers, right? So
yes.
It kind of blows my mind, the amount of annuities that teachers have that they don't need, Like in California, there's a state teachers retirement system, which is a pension, which is just like an annuity. And then in their 403B over here, they're being sold annuities as well, right? And I think the industry average cost of an annuity is like somewhere like 2% overall. And if you get one of those guaranteed riders on phantom money, it's even more, which doesn't make sense. So you can do a back of the napkin type calculation. Just figure out how much money that you want to have guaranteed coming in to figure out your essential expenses. And then anything beyond that, then you have to control risk, right? So if Marie wants to reach out, I'd be happy to do a back of the paper napkin type quick calculation.
No, absolutely. Good point, Amar. I mean, for heaven's sake, guys, reach out to Amar too. I mean, Mar's a good guy. He's not going to bite your head off. And a lot of people might say, maybe I don't know. You have to determine for you and Amar the services that you want. But I get a question like, hey, I got a guy today from your area. He said, hey, can you call me to discuss my situation? I'm like, I can't, man. The phone rings here. And I always say to people, so I have a website that goes into it. I simply don't have the capacity to call the people who want to discuss my services before we engage, rightly or wrongly. And I don't want to sound arrogant, but I just don't. But if you're interested, folks, call Amar. Hell, I mean, he's a small company, a small shop. He's trying to get a certain level of clients. We work together, and I trust him implicitly. Emily, I do want to talk just 2 seconds on this. The friggin' reason I cannot stand variable annuities, there is something called M&E. It's called mortality and expense fee. And it friggin' pisses me off because what they're doing is they're essentially charging you life insurance. And the life insurance is usually 1/3, 25 to 35 basis points. So essentially 1/4 to 1%. And they're saying what happens is when you die, your portfolio will always be at least what you put into it. So if I add $100,000 and now my annuity is worth 150 and I die, well, my wife gets 150,000 bucks. All right. If I have $100,000 into annuity and it's worth 75,000 and I die, my wife gets 100,000 bucks. I hope that makes sense, because if the market goes below my initial cost, they'll up it to what was my initial deposit in there, minus distributions, whatnot. The problem is it's such a freaking scam, because what happens is you're going to have $25,000 of life insurance, worst case scenario. However, I'm paying 1/4 to 1/3% every year on the total portfolio value to cover $25,000 of life insurance in this scenario. It's the biggest freaking scam there is, and it drives me up the wall. And then you're sitting there thinking, why do I have an M&E expense if my portfolio value is 150? Even if I lose 25%, I'm still above what my initial cost was. What am I getting? I hate that, and I don't understand why the insurance. This is what drives me crazy. The reason why there's so many insurance guys on YouTube and very few people like Amar is because people like Amar are regulated to freaking no end, where the insurance guys are regulated by state and they can say whatever they want. I had a guy the other day, Amar, email me this guy's video, an insurance guy. This guy's out in your neck of the woods too, Sergio. And he goes, hey, you ever seen this guy? I said, dude, these guys, they're acting like if you have $1 million in a 401k and you put into a universal life or whole life policy, you don't have any taxes due. I'm like, these guys are friggin', it's insane. It's insane. Oh, it drives me up the wall. Eddie Cole says he's smart. Okay, I challenge that, Eddie. If you're watching this video, I wonder if you are. All right, Mark says, here's one for you, Amar. My FIDO account uses average cost basis. I have made multiple purchases over the last year. Do I have to wait for all purchases to be there for over a year to qualify for long-term capital gain status when selling?
So this is what you got to do. You got to, if you're at Fidelity Retail, so I'm sure you have an advisor or somebody that calls you, you want to change your cost basis to a lot specific cost basis. So that's the first thing. So step one, change to a lot specific cost basis. Then once that takes into place, when you click on your investment, you'll be able to drill down to each line item when you've purchased it. If you do dividend reinvestment, it will have each dividend reinvestment as a separate purchase. Then you can go in there, and once you click on each, let's say you click on one of the line items, it will give you whether it's long-term or short-term. So each date has been listed, it itemizes it there for you. So it's really easy, easy to do with Fidelity. I custodian with Fidelity and Schwab are the two custodians that we use. Both of them are really easy to change your cost basis method to lot specific.
You hearing any news negative? I'm getting a lot of negative stuff on Vanguard, just service model. You hearing that, Amar?
Not, I mean, so I'm not hearing anything specific. Okay. We are moving accounts from people that have Vanguard to our firm because they want more service, right? And they want to reduce the stress around investments. I mean, this is my thoughts on Vanguard. Vanguard is a huge machine. It's big. I mean, and they get something like $10 billion of net new money each month or something like that. It's like this enormous. I mean, how do you keep pace with that type of growth? It's hard. And so from when I was at a big firm, the saying used to be, at Fidelity, you would have 200 clients. Schwab, you had 400 clients. And Vanguard, you have 800 clients, right? Yeah. I mean, it's and if you want a personal relationship with your advisor, I mean, it's really hard to have, when you have. Now I know they're working on it. They got different tiers. They have a new wealth management tier. If you have $1 million or more, then you get a little bit more service. But I mean, they're working on it.
Let's see. My man Harry in Oklahoma says SPIAs, single premium income annuities or immediate annuities, are working great for me. Remember, this is the frustrating thing for me. The whole annuity umbrella is so many different things under the umbrella of an annuity. A SPIA is different, and a SPIA is just a pension essentially. And I'm not for or against SPIAs. I'm actually right now. I'm not keen on SPIAs so much. And I know Harry's circumstance. So in his case, it works like a charm. And I would suggest for other people to consider that. I'll do another video on that again. But we're talking more deferred variable annuities in this regard, Harry. So SPIAs are just a little bit of a different beast. So and on top of that, when you hear the word annuity, I'm so annoying chatting so much. Okay. Then get out of here. I don't care. Jeez Louise, man. He's talking to you, Amar. Martin Zamora says, Amar is so annoying chatting so much. When it comes to income annuities, when it comes to word annuities, don't immediately throw the baby out with the bathwater. It doesn't make sense because there are some benefits to them. I'm telling you, there are for sure. Eddie says, how about life insurance? We'd have to know more what you're asking. Amar, Marie wants to know your info. So do you see the chat there by chance or?
On Zoom, I don't.
Oh, no, that's right. You're just on Zoom. All right. Let me just get his website here is clientfirstcap.com. So let me just ask, do you do any insurance products or you don't?
So, we do like Medicare insurance, like the supplement through United Healthcare.
Oh, so you are doing that?
Yeah. I mean, again, we want to give our target audience the full range of products that they need during their lifetime. So we're trying to be like a one-stop shop, right? Where like everything is done at one place, everything is coordinated, right? So there's no missing gaps. But we do have access to sell life insurance, regular health insurance, and other insurance-based products. Do we do it on a ongoing, or do we proactively do it? Probably not. I mean, like it's truth be told, this is how it happened. I've had a lot of individuals say, "Hey, I have Medicare plan F, and I have some questions about my supplement." And so, like, gathering data was so hard that we just decided, well, here, we can be your advisor on record, and then we can have all the data here. The same thing with people that have annuities.
Yes, I was going to ask about that next.
They have annuities with another firm. They say, hey, I want to bring this over. Well, if you do that, that's a huge taxable event. We could be advisor on record. We can 1035 it into a investment-only annuity, which avoids that M&E stuff that you were talking about earlier. And so we have it as a means to help clients that already have insurance products. And for the very few clients like that you were mentioning earlier with the SPIA, if it makes sense, then we can use it as an option. I just don't like advisors that don't use a full toolbox, right? Like they're saying, like, I'm fee only, and I'm comprehensive. Well, you can't be comprehensive if you're fee only because you're not taking into account risk factors in and that's just a personal thing that I have, I guess, with that.
If someone had a good position, let's just say, like we used to work at USA, and then they custody with Schwab or something like that. But they have, a lot of unrealized gains and stuff. Can you become the advisor on their accounts, or do they have to sell everything and come over to you?
No, I mean, we have 3 product solutions, right? And some people just hire us for advice. Like, hey, I want to manage my own investments, but I want you to do proactive advice based off of what we do. So one of our clients, we're working with options to lock in that value. They don't want to sell the specific security, but they're okay if they lose out on gains or they don't have any losses. So we're working on an option strategy to lock in that value. So yeah, I mean, we want to do what's best for our clients. So if we're not managing that money is best, I mean, that's what we're going to suggest.
If they have, I guess what I was saying, more like a broker to record, if they already have Schwab, and let's just say they have a different RIA, and the RIA is just a clown.
It's just a 1-page form, or
That's what I was going on.
it's a 3-page form if you have Schwab. It's change of advisor.
Exactly. That's what.
And you change your advisor to Client First Capital, which is us.
Yeah.
Or if you're at Fidelity, it's a change of advisor. And I think theirs is like a DocuSign that we have to send out. And then it's all done electronically, and it happens all the time, I mean,
I get this, not so much anymore, but a lot with just a change of advisor, and that's so easy. So if you're already working with a guy who's a custody, if you're already working with a guy who's custody at Schwab, and by the way, for all you crazy people out there, when I say a guy, that's all inclusive of guys and ladies too. It's just the industry as a whole. If you're working with a guy who's custodying your accounts through Schwab or Fidelity, and you're like, I just don't like the guy anymore. He seems like he's too busy trying to sell me stuff, but I like my holdings, or you may have some reason to keep those holdings, and you like Schwab, you contact Amar. Just 1-page, 2-page form, change the advisor record. Easy.
Yeah, and biggest benefit is you keep the same account numbers, you keep the same tax reporting, the same statements, right? We're not holding money. Their money is still at Schwab. You have the same login. If you have the app on your phone, everything's the same. It's just the advisor on record, the person that has access to all your back end files, like your tax records, everything else like that within that custodian, is what we get access to.
It's nuts how much the industry has changed, because in the old days it wasn't like that. Now it's just as crazy. My man Moon says, Amar, I didn't track your comment that you can't be fee only and comprehensive at the same time. So we want to talk on that.
Yeah, and this is a personal beef that I have with the industry. It's so when you're fee only, you're basically saying that we're not selling any products, right? It's we charge this fee, percentage of assets under management, and that covers everything that we do. But what you'll find is that through life, you're going to have different things that come up from a financial planning standpoint that investments are not going to be the solution for. For example, health insurance, disability insurance, long-term care, life insurance, right? So I feel fee only is a misnomer, because you can't give and so people that are fee only call themselves comprehensive financial planner, and I'm fee only. Well, you can't do that, because if you're a comprehensive planner, you need to be able to give advice on health insurance, life insurance, long-term care, right? And you have to be able to provide a solution, right? Because you get the education, but if you take no action, then there's a disconnect there. So in our industry, there's you're either fee only or you're an advisor that sells products. I mean, that's kind of how marketing or whatever has painted it. And I just disagree with that, right? There's going to be people. Let me give you another example. If somebody has a bunch of bonds, right? They're buying individual bonds, right? And the guy's like, hey, I'm fee only. I'm just charging a percentage of assets under management, blah, blah, blah. Well, that really doesn't help the end client, because you take that same person, if they were to pay a commission to buy that bond, where does that commission go? It gets added to your cost basis, right? Whereas a fee only, you can't deduct that, the financial planning fee. And I charge a percentage of assets under management, or I give advice. But I guess what I'm trying to say is that to say that you're comprehensive, you can't just do fee only investments. You have to do it just doesn't ring true to me.
I'll give you an example. When I was working at a firm, an RIA, after I left USAA up in New Hampshire, we the one guy, our investment guy, our CFA guy, he happened to have a life insurance license, and I was holding myself to be at the firm fee only, but because this guy actually got commissions to sell life insurance, and he only did like 2 or 3 a year, just term, like $250,000 term policy through, I don't know, Bannon or whatever the hell it's called. It's like once or twice or 3 times a year. The CFP board made me take off my thing saying that's fee only. I said, well, I'm not even doing it. It's this guy. He goes, well, your firm can get a commission on selling term life insurance, and as such, you cannot be fee only. I said, Okay. I mean, is the weird, it's just the whole thing is just, it's weird.
I believe it's a marketing push.
Totally.
And-
Kind of like
and
the
so, like-
fiduciary thing, Amar, the whole fiduciary. I'm a fiduciary. I'm like, oh, it's totally marketing. It's evidence-based, it's marketing. I'm a fiduciary, marketing, fee only marketing. That's it. It's just, it doesn't mean anything. It's just, it's so thin, drives you up the wall. All right. Carl says, why are advisors legally able to put a Roth IRA into an annuity, or more like an annuity into a Roth IRA? Seems criminal and reeks of fraud. I don't know why.
Yeah, I mean, so annuities and IRAs and Roth IRAs is probably not the best choice, right? Like you shouldn't have that. I think what's happened is that, like my example with the teachers, right? They have an annuity source of income through pensions, and then their 403Bs are also in annuities. All they've known is annuities. So when a salesperson tells them to put their IRA into an annuity, then it makes it an easier conversation. Some of these annuities have come out with riders and benefits that could potentially make sense. One of them that I've seen is like a long-term care rider within an annuity, where then you can take the gains out of your annuity to pay for long-term care benefits tax-free, right? Because it's coming out of the Roth IRA. So I don't know. I mean, I'm sure they're 99% of the Roth IRA annuities is probably not done correctly, but
yeah, I don't know. People get mad about it all the time. Why are you not getting double tax deferral? And this is just with a traditional IRA and annuity. I said, there's more than buying an annuity with just tax deferral. In fact, one of the issues that always kind of ticks me off is, well, you're taking long-term capital gains in a regular taxable account and you're putting it into a deferred account where it's going to be taxed as ordinary income. And I said, well, you better not do your 401k either then. That's the exact same scenario. And so look, I get there's probably a good case to be made that you should be careful about buying an annuity inside a Roth IRA, but in of itself, there are reasons for some of this stuff to work. It just.
And I think, again, this is hard on YouTube, right? We need more context around some of these questions.
100%.
Yeah.
So I'll answer this one real quick. My man Moon, to go back to your question, if a fee-only advisor appropriately offsources products back to a client or a referral, that's not comprehensive. No, look, man, that's semantics in some regard there, Moon. But the issue is that the fee-only advisor, if they're going to say they're comprehensive, well, doggone, they better be comprehensive. And if they're just saying, look, it's kind of going back to the Roth IRA and the annuity thing. There are some guys who are comprehensive that are fee only because they do outsource that stuff to other people and they follow through with it for sure. However, the majority, in my opinion, I bet Mark can agree with this, they say, I don't do that. You need to talk to somebody else. That's not comprehensive. That's not, well, do you have anyone? Yeah, I don't know. Look at your State Farm rep or look at.
Yeah, I'll give you 4 people to talk to, and then I won't follow up on that.
But
so I guess it's in the words, right? That we're trying to slice and dice this. But I guess I would say is that somebody can be a comprehensive planner and do a comprehensive financial plan, but they're not going to give you comprehensive solutions
to the
gaps that you have.
I think that's
right, because they only sell fee-only investments as a second product.
And
Which in that case, they should be charging a fee for the financial plan that's separate from the investments.
Yes. As such, though, they're leaving it up to the client who is in the guy's office for a reason, because that client doesn't want to go to 8 different people for various things. It's the way it is. My man, was I fee-based? I was fee only, but I was also, I'll go to my grave saying I would much rather have an Ed Jones guy sell me A-share American funds than pay some guy 1.5% year over year over year over year, 100%. That does not mean paying some guy 1.5% is always the worst thing, since some Ed Jones guy put me A-shares American funds. From a pure cost perspective, though, it's not debatable to me, not in the least. Now, the Ed Jones guy has a commission he got, so he was fee-based. He got a commission. Amar gets commissions on selling some products. In of itself, that commission is not the worst thing that ever happened to people. It's just not. The brokerage industry has made this go of it, saying, we don't sell for a product. We have no one to advise it. We don't take industry kickbacks and stuff like that. No one does that, man. I mean, those days of taking industry kickbacks are so far removed from what anyone's doing anymore. To get paid a commission does not make you a bad guy in the least. To get paid a fee doesn't make you a good guy in the least. All that stuff should be disclosed. And frankly, I find it the commission guys are under a whole hell of a lot more heavy lifting now than the fee guys, because the fee guys say, I'm just charging you 75 basis points, Mrs. Smith. That's nothing. When you actually look at the dollars, that's a big difference. If you actually look at the dollar amount, that's a big difference. And that dollar amount is perpetual. Near retirement CB, the real CB, says you could go 60-40 or 70-30 in Wellesley, Wellington, and then migrate the next handful of years to the opposite. Well, 100%, lots of different strategies to do. So basically what this, you don't have nothing that needs to be said here. Way to avoid sequence of return risk. Tom says, can I transfer my traditional IRA to my simple IRA? That should be an easy one there for you, Amar.
Yep.
And then he says, how is the RMD determined if you were to do that?
So, I mean, there's an RMD table starting at age 72.
Same thing as the.
It's the same calculation, right?
Yeah. Moon says, thanks for clarifications. Yeah, right on, Moon. It is what it is. Let's not get caught up in the semantics of I hate with a passion this whole industry that says I'm evidence-based. Are you familiar with that term, Amar? You know what that's referring to, the evidence-based model? The guys at DFA, the dimensional.
Yeah.
We use Nobel laureates. I'm like, I could give two freaking rat butts. I don't care. My goodness, there's no evidence on future returns. We don't know what it's going to be. It's nuts. And I'm a fiduciary, and I hate on fee only as opposed to on fee based, as there's some main, oh my goodness.
Yeah, we don't use DFA, but there are DFA funds that, they're value tilted, right? So like the first half of the year, they were hurting quite bad, but they use different factors that they think will outperform, and they move money from one factor to another, during different market environments. And, they have all these PhDs that say it's research, but nobody knows what the future holds, right?
That's what I'm saying.
That's what I tell everybody, is that like when we're looking at returns and we look at, how our performance has been, I mean, I don't know how our performance is going to be. I mean, what we control is risk. And if we can control the amount of risk that you feel comfortable with, then given different market environments, you'll get an appropriate rate of return, right? So if the market environments go down, you'll get a certain return. If the market environment goes up, you get a certain return. And so it's up to your advisor, or myself in this case, to really determine what's appropriate from a financial planning perspective from your plan, and then what's appropriate for you that you can actually handle in terms of upside and downside. So like one of the things that we focus on when we talk about risk tolerance is how much can you afford to lose? What is your downside risk? What's your worst case scenario? Once you know that number, then using statistics, you can go 2 standard deviations from there, and then you can estimate what your average return will be. So like 95% probability that your returns will be higher than whatever your downside risk is.
And Amar has an engineering background, so if he's kind of a geek, but in a good way for sure. And I say that with all joking. But he does have an engineering background. The issue is that the whole thing about DFA is, remember, the first part of this century, the DFA was all that in a bag of chips because the value tilt played out well, as we could see by Windsor Fund, Windsor 2 Fund, Wellington, Wellesley. They all did better than growth. All right, so the 90s is growth, the aughts is value, and the teens is growth again. Inherently, most likely, would think that DFA would be proven to be good again in the 2020s, just because it seems to be this up and down. But there's no evidence to validate that. We can't validate. The evidence would suggest if this happens, that will happen. And what happens with DFA and the French FAMA model, they used to have these 3 factors. They've since gone to 5 factors. And it works until it doesn't, man. And secondly, I did a video today earlier, Amar, on Schiller. You're familiar with the Cape cyclically?
Yeah.
Well, everyone their mom say the Cape. Was that?
the risk-free plus like the change of return. Go ahead. But
I think you're talking about CAPM. I'm talking about the CAPE, which is the cyclically adjusted price earnings ratio. And basically the whole point was that Shiller came up with this creation that said, look, we're above 30. And anytime it's been above 30, this, the market's crashed and all that. It's been like that since 2008 now. You see what I'm saying? And the issue, but the funny thing was Shiller, a Nobel laureate from Yale, Eugene is a French or Fama, I think it's Fama, a Nobel laureate from Chicago, who's part of the French Fama DFA stuff. But the issue is Shiller now has a different model to go along with CAPE because CAPE hasn't worked for the last 15 years. So now he's saying, well, because of that, I'm going to get this new model out. I just did a video on this today because it's like, look, I got no qualm with these guys. I don't have no problem with academics, but I'm just saying the idea that these academic and your man Proctor, freaking Amar, he says we need to get the technocrats like they do in Europe every now and again takes 9 months off and tell us how to run our economy. I was like, Proctor, what the hell? Well, you can't, these guys don't know their freaking butts from a hole in the ground, man. Just because they have PhDs and they study at Chicago and they have the Ivy Halls. Screw all that. Anyway, the point is all this stuff changes when it doesn't work. And so if we follow these models that they're evidence-based or academically sound, I just want to take an anvil. Now, you know what I want to do? I want to take my new dog who takes poops about the size of your head, Amar. I want to hang him over my head and give him some chili and some Mexican food and let him just poop all over my head because that's how I feel when I listen to this stuff. I feel like I'm being crapped on by the whole world. It's nuts. This is professionalism, my friends, professionalism right here that Amar did not sign up for, but it frustrates me no end. Chuck says he thinks the initial concern about the commission was the churn of the previous advisors. 100% agree with that, Chuck. But that's not the advisor. That's the advisors, don't get me wrong. That's actually the lack of
supervision.
100%, the lack of supervision. And along those lines, let me tell you, when I was in training as a broker in 2003, is after I left Vanguard, 2003, I think. We had our guy who said, this is how you can make $1 million in a year in this business. And it had nothing to do with the clients. It says, see 3 people a day because you can sell one thing and buy another thing. That's $300, $150 commission on the front end, $150 commission on the back. If you do that 3 times a day for how many days there were in trading days, you will make $1 million. That's literally churn and burn right there. And that was not only lack of supervision, it was incentive to get you to churn and burn. And that's that's back into the beginning of the century. But see, that's crap. Let's see. Engineers are great, says Ralph Parker.
Computer science and electrical engineering. IEEE.
And a CFA. Just ask them. They'll tell you how great engineers are. How has the popularity of retail investment apps like Robinhood affected the volatility of your business, Amar? That's a pretty good question. What do you think?
Yeah, I mean, so Robinhood, first of all, Robinhood's app has crashed like I think 4 times this year when people have tried to place trades on that. Most of our investments are long-term, so we follow models that are 3 to 5 years out. So some of the short-term noise we don't really focus too much on. And so Robinhood, I know what it is, but it's not like we're competing against them I think the average account at Robinhood is less than $25,000. So right. It is your quintessential retail investor. So what I would say is like in Thanksgiving, when most people have time off, we saw more volatility, right? Because they have the app and they're not working and they can place trades. So you do see some noise from that regards, but hopefully that answers that question.
Ralph makes a mistake as the engineer he is. He says economists were created to make weathermen look good. No. Economists were created to make astrologers look good, Ralph. Amar is being very professional, says Pulverizer. Josh is being his normal zany self. Yeah, that's probably true. That's
just maybe just engineering me more.
That's what I'm saying, right? Exactly. We put a couple pints of Guinness in Amar. He'll be just.
I'll get my. I don't know if.
Moon says that's pretty funny. I think Josh just said that Amar has a poop-shaped head. we got a mechanical engineer and a computer science guy on here. So that's good stuff. All right. Well, we've been on here for about a while here. So this is fantastic. Good stuff. All right. So let's not familiar with astrologers. You know, the people that, you know, the carrot cards or whatever, what are they called? Carrot cards or tarot cards?
Tarot cards.
Tarot, so whatever that is,
Yeah.
You know, astrologers, like they look at the stars or
You
the
read the palm, say
the
you're gonna-
horoscopes. Yeah, that's it, right.
Yeah. All right.
And look, I study economics. Economics. I love it. I think it's fantastic. But when they got out, they got out of their lane. They should have stayed in their lane where they said it's more of the psychological side or the physical or the philosophical side. Instead, they want to be. They have what's called physics envy, guys, in this economics. They want it to be a hard science. Because that's where, after the Eisenhower said this in his farewell address, that the sciences were starting to become too much involved in the government. And if you wanted funding, you had to be science, hard science, the math and stuff like that. And so the economist says, we want some of that sweet government funding. And so they started becoming Paul Samuelson school and stuff like that, mathematics, which no one can understand because it's meaningless for sure. Sniffy Joe. Sniffy Joe is watching, says good stuff. Remember, it's not Sniffy Joe anymore. It's Steely Joe. That's my name for Joe Biden's Sniffy Joe, because he likes to sniff little girls' hair. Pretty disgusting. All right, so Amar, client first cap. So what we're going to do going forward is Amar and I are working together. I know there are people that need guidance. I know that. I know I cannot help some people who need it, and some people who need it are willing to pay more than my fee. I've actually negotiated. I said, Mar, I'm willing to freaking refer anyone who wants more white glove, hands-on, proactive treatment. Absolutely. My fee is this. And as such, though, Amar lives in California. He can talk to anybody for sure in all 50 states. But to get more white glove treatment, it's more of a fee. It's just all there is to it. It's just all there is. So I haven't figured out what the fee is truly going to be yet, but that will be coming, because I look at my email. I love it. It's a great problem to have. I see it all the time. And I don't have the ability to, but I know there are people who need it. I do. And I just can't. And as such, Amar, I'm trying to help him build his business, because it's hard in that realm to build. It's a tough business model, or being a registered. And
nobody knows me, right? Like, they just know me as, and I have my whole career ahead of me. So, like, and
Amar's not going to
build a relationship for
absolutely. He's not going to retire and sell you to some freaking, he's not, how can I say this? I've been in this business for so long. I've seen what happens with transitioning guys, RIAs, who get either too old or they get too big for their britches and then are bought out by another firm. I see this happen all the time. And next thing you know, you are being told you can't talk to this person unless they have a certain revenue. And that freaking ticks me off. And look, who knows what the future holds, but I like Amar for sure. So I get a lot of questions like, who should I talk to if not you, Josh? Well, Amar's the guy. There's all there is to it. We're working on a scenario we'll get more to you for the fees. Like, it has nothing to do with me. Don't call me and say, Amar, I found out he likes the San Diego Chargers. It's not even around anymore.
No, it's Los Angeles Chargers.
Yeah, exactly. But we'll put in the comments, his comment section below. If you want to be kept on Amar's list as an email, he's not going to solicit you. Say, hey, I'm selling a new product. Sign up. I put the link on his thing. I'll put it again in here for his download on tax planning, because I think that'd be helpful to you for sure. And if you don't want it, just don't check the box. But remember, if you do want it to be kept in touch, you got to proactively check the box that says, Amar, keep in touch with me for sure. Sniffy Joe says, they tell me I won, did I? Well, I can't say anything because YouTube will ban me. Last thoughts, Amar?
No, this was good. I think we should do some more videos like this. I have a lot of pieces that we can walk through, and hopefully it will be helpful to people out there as educational content. And if you don't mind, Josh, if I can just put my disclosure back up, so that way I think cover my patootie with the compliance people. And that's all I have. Happy to help. Happy to do a back of a napkin, just quick calculation or quick answer some questions. But
all right, Amar, thanks, man. There's the compliance stuff. Just we'll let that sit for a second here, so Amar doesn't get in trouble by the regulators. And then I'm going to go take my dogs for a quick walk around the block so they can, instead of pooping on my head, they can poop on outside.
Sounds good, Josh.
Hey, thanks, guys. See y'all. Thanks, Amar. I'll text
All
you.
right.
Thanks.
Yep.